This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, everybody. It's Joe. I want to spend a few minutes discussing something that might be construed as short-term trading, but in reality, I recommend it to learn this technique. Even if you're looking to put on an investment, like hold something for several months, even try it for several years. What I have found is that if you employ what I'm going to show you today, I would say probably like 20% of the time, it might you might end up avoiding putting on a position, or at least at that point in time, which would end up turning into a losing position. And so it's all about bogey avoidance. I keep talking like golf analogies, trying to avoid bogeys as much as possible. And even if you have everything in place and everything looks good and you get a trigger, I want to make sure you know what I think is important to recognize when the trigger is taking place, because we have a lot of gaps going on. And when gaps take place, you need to be careful about your entry in terms of whether to buy on that gap coming through the trigger level. So let's go ahead and get into this example. I'm actually got a graphic here. I want to show how I would go about handling a gap up or a gap down, and how at least I think if you have a few techniques with respect to the gaps, then I think it'll increase your confidence. And you just want to have some methodology that you employ on a consistent basis. It's really not about being right 100% of the time, but if you have a consistent approach, then I think, in an approach that makes sense relative to what's taking place. So I've got this big green candle here. That represents the level where, and I've got the dotted line going across, that represents basically the trigger level. Now, that could be based on a pullback, like a 3 to 4 bar pullback, and we're breaking the down, on a pullback trade, we're getting ready to turn back to the upside. That very well could be the reason for why you're getting a trigger. And then it also could just be a breakout. So we're breaking out of this sideways consolidation pattern. So it really doesn't matter from that standpoint. I notice, I would say more often than not, if you have a narrow range bar, if you have narrow range, so let's say the day of the day before the trigger takes place, you get a small range. The likelihood of some kind of a gap taking place after a narrow range seems to be higher. So you kind of want to recognize that. And I want you to recognize the games that these guys are playing. So we have this level that's key. If it comes up through that level, we would consider that to be a buy signal, a trigger. Okay, so, we want to look at it that way. Now, if you gap up, let's just give you a couple examples. Let's say we gap up, and we gap up pretty big. The more you gap up in terms of distance away from the trigger, the more conscious you have to be about this strategy. Okay, so let's say we've got a $50 stock, okay, and it gaps up a point or more, 1 point or more. I think you got to be, if you're talking about taking on an additional point of risk based on an entry, which is just based on like a gap up, which is almost like slippage, then I think you have to be very careful about just jumping aboard. Okay. Now, if we gap like this, one of the things I want you to recognize, this horizontal line is the open. Okay, the open is the key. It is the absolute key to recognize on a gap. So what happens after the open? Do we open and just drive to the upside? Or do we open and start coming straight down? Those are the types of things I think you got to be recognizing, whether you gap up big, gap up small, gap down, anything like that. You want to see what happens right after the initial open, because what we're going to look for is if we open and then drive to the upside, and our opening price is here, and we've moved up, say, another 50, 75 cents or a point, then what you're actually looking for is a pullback towards this opening area sometime in the first half hour to 45 minutes as an opportunity to be a buyer. And it might end up trickling down underneath, and when it comes back above, you could almost look at that as a buy signal. So maybe on a 5-minute chart or a 10-minute chart, you're getting a little pullback, and then as it turns back up, that would be kind of like your single to get in. So want you to just be on the lookout for these big gap ups, because a lot of times what will happen is we'll open and then get a little move to the upside, and then it'll come back below. And what I would recommend to you is mark off the high for the first 10 to 15 minutes. 15 minutes is a pretty good barometer. And let's say that's the high for the first 15 minutes. If you never get back above that price for the rest of the day or any time during the course of the day, then you never get in. Okay, so if a stock gaps up above your trigger, so we have a trigger in place, it's a live trigger, and it pushes up somewhat and then comes back down. Our new real trigger is here. I don't want to get in below this level, because a lot of times that'll be the high of the day. And I've seen it where, and believe me, I've gotten in on this pattern where it comes like this and it kind of messes around and then it looks like it's going up. And this is all happening in the first 5 minutes, and I get long. And then it makes a top after 10 minutes and turns down and then just goes down. And then 3 or 4 days later, I get stopped out at my original stop. And this is even for an investment, like giving it a lot of room. So you got to be careful with just buying any gap up like that, even if it is sufficing the trigger. So let's just say you get a smaller gap up. So it's only like a 25 cent on a $50 stock, say 20 to 25 cent. It's not that big. What I'd actually want you to look for is a move back and getting really close to filling the gap. And then when it comes back up through the open, by any margin, 5, 10 cents, anything like that, that would be my trigger to get long. Okay, so you're not really giving up that much more than your trigger price by waiting for it to get back above the open. But again, it'll save you, and it might save you a day. Like it might just be another day where you're not in and you're watching. Or again, it could just fail and just keep dropping. And a lot of that could be market dependent. Now, let's just take another example. Let's say it actually gaps down. Not a big gap, but some 50 cents or less. Gaps down maybe to the middle of this bar or something like that, and then it just starts driving to the upside. It might fiddle around and be below it for a little bit, and then moves back to the upside and crosses through the trigger. This is a signal that you want to take, and you don't want to wait. You want to just buy the moment this comes up through the trigger level if it plays out this way. That's basically a gift, I think. You're getting an opportunity to get in at the trigger level without any, gap consequence. You're well above the open. A pretty good barometer for the opening price is around 25 cents. And again, I'm using like a $50 to $100 stock. 25 cents is a good level to watch. If you're, in other words, a $50 stock could trade within 20 cents in either direction around the open without really making a decision. But once it gets either 25 cents above or 25 cents below, it's probably making a decision that it's actually heading in that direction. So just a good barometer to use. Keep an eye on that 25 cent mark. Now, if you've got a $300 stock, obviously that number needs to be a little bit more, 50 cents or more, something like that. But that's a good thing to keep an eye on relative to that opening price. Now, if we get the type of signal we're looking for, I don't know that I would wait for the full 25 cent move above the open. If it comes down and fills the gap and comes back up through the open, I think that's a good enough trigger, especially if you're above the prior day's high. I don't think there's a whole lot of triggers that take place below the prior day's high, but I guess it's possible. But if you get some kind of a trigger, so let's say we open here and come back down and then work your way through the opening price, but you're still below the prior day's high, I would sort of question that a little bit unless you get 25 cents above this open. And preferably, I want to be above the open and the prior day's high. That's really kind of in the, it's really the green light zone for any kind of a trigger sign for a trade. So these are just small techniques that I want you to be aware of. Again, it's not the end of the world. And believe me, if you're a day trader, intraday trader, this isn't going to help you that much. I'm not giving you all the techniques to use to trade around the open. I'm just trying to show you if we have a trigger here and I'm kind of conscious of this price. So that, let's say that trigger price is $50. I'm trying to get it as close to 50 with the confidence that it's actually moving in my favor that day. I really don't like to hold stocks at a loss. So if I know my trigger is $50.25 and I'm buying it and yet I'm going to be down the entire day, I'm sort of hesitant. I'm not that interested in buying something and having it immediately go against me. Now, obviously that happens sometimes, but if I can prevent that by recognizing that it's below the open on a minor gap that morning and that it was a novice gap that really didn't have any juice behind it, and really all you were doing was getting some of these market maker kind of guys to suck people in to buy the open and then they were selling it off after that. If you get involved in that kind of a trade, it can be pretty demoralizing. And I know a lot of people that if they're in a stock and it's down, after the first day, they just exit. They don't want to hold a loss, recognizing. And I know some of you have been in this position because I know years ago, I used to do this all the time. I'd feel it where you buy and almost within 15 minutes, you knew it was the wrong thing to do. You bought it and it just kept dropping and you're like, oh my God. I mean, this thing is literally just, I top ticked it. I got in and it just dropped the rest of the day, or at least stayed below my entry the whole day. So that's pretty frustrating, I think. And I think you have to be careful because a lot of your confidence will stem from your first 2 to 3 hours in a trade. If you buy a stock and it works in your favor for the first 2 to 3 hours, you have a much stronger conviction about that trade than you would if you buy it and have it immediately go against you. So I'm always trying to have something work in my favor initially so that at least I'm willing to follow my plan. Because I think if you buy something and have it go against you immediately, those are the ones that are hardest to follow your plan on. So anyway, hopefully this is helpful to you. If you have any questions or comments, go ahead and post them. Thanks.